The market cycle model. By now, it is apparent that the price levels of any market is influenced simultaneously by several different trends, and it is important to understand which type is being monitored. For example, if a reversal in a short-term trend has just taken place, much smaller price movements may be expected than if the primary trend had reversed. Long-term investors are principally concerned with the direction of the primary trend, and thus it is important for them to have some perspective on the maturity of the prevailing bull or bear market. However, long-term investors must also be aware of the intermediate and, to a lesser extent, short-term trends. This is because an important step in the analysis is an examination and understanding of the relationship between short and intermediate term trends and how they affect the primary trend. Also, if it is concluded that the long-term trend has just reversed to the upside, it may pay to wait before committing capital because the short-term trend could be overextended on the upside. Ignoring the position of short-term trend could therefore prove costly at the margin. Short-term traders are principally concerned with the smaller movements in the price, but they also need to know the direction of the intermediate and primary trends. This is because of the following principle. Major technical principle. Surprises occur in the direction of the main trend, that is, on the upside in a bull market and on the downside in a bear market. In other words, rising short-term trends with the confines of a bull market are likely to be much greater in magnitude than short-term downtrends, and vice versa. Losses usually develop because the trader is in counter-cyclical position against the main trend. In effect, all market participants need to have some kind of working knowledge of all three trends, although the emphasis will depend on whether the orientation comes from an investment or a short-term trading perspective. Major technical principle. The direction of the primary trend will affect the character of intermediate and short-term trends. The direction of the primary trend will affect the character of intermediate and short-term trends. Two supplementary trends. Intraday. The post-1990 development of real-time trading enabled market participants to identify hourly and even tick-by-tick price movements. The principles of technical analysis apply equally to these very short-term movements and are just as valid. There are two main differences. First, reversals in the intraday charts only have a very short-term implication and are not significant for a longer-term price reversal. Second, extremely short-term price movements are much more influenced by psychology and instant reaction to news events than are longer-term ones. Decisions therefore have a tendency to be emotional knee-jerk reactions. Decisions therefore have a tendency to be emotional knee-jerk reactions. Intraday price action is also more susceptible to manipulation. As a consequence, price data used in very short-term charts are much more erratic and generally less reliable than those that appear in the longer-term charts. As a consequence, the price data that used in a very short-term charts are much more erratic and generally less reliable than those that appear in the longer-term charts. The secular trend. The primary trend consists of several intermediate cycles, but the secular or very long-term trend is constructed from a number of primary trends. The supercycle or long wave extends over a substantially greater period, usually lasting well over 10 years and often as long as 25 years, though most average between 15 and 20 years. It is discussed at great length in Chapter 23. A diagram of the interrelationship between a secular and a primary trend is shown in Figure 1.2. It is certainly very helpful to understand the direction of the secular trend, just as the primary trend influences the magnitude of this is Figure 1.2, the relationship between secular and primary trends. It is certainly very helpful to understand the direction of the secular trend, just as the primary trend influences the magnitude of the intermediate term rally relative to the counter-cyclical reaction, so too does the secular trend influence the magnitude and duration of a primary trend rally or a reaction. For example, in a rising secular trend, primary bull markets will be of greater magnitude than primary bear markets. In a secular downtrend, bear markets will be more powerful and will take longer to unfold than bull markets. It is certainly true to say that long-term surprises will develop in the direction of the secular trends. It is certainly true to say that the long-term surprises will develop in the direction of the secular trends. Bonds and commodities are also subject to secular trends, and these feed back into each other as well as into equities. I will have much more to say on this subject later. Peak and trough progression. Earlier, we established that the technical analysis is the art of identifying a price trend reversal based on the weight of the evidence. Technical analysis is the art of identifying a price trend reversal based on the weight of the evidence. As in a court of law, the trend is presumed innocent until proven guilty. As in a court of law, a trend is presumed innocent until proven guilty. The evidence is an objective element in the technical analysis. It consists of a series of scientifically derived indicators or techniques that work well most of the time in the trend identification process. The art consists of combining these indicators into an overall picture and recognizing when that picture reassembles as a market peak or trough. Widespread use of computers has led to the development of some very sophisticated trend identification techniques. Some of them work reasonably well, but most of them do not. The continual search for the Holy Grail or perfect indicator will undoubtedly continue, but it is unlikely that such a technique will ever be developed. Even if it were, news of its discovery would soon be cemented and the indicator would gradually be discounted. It is as well to remember that the prices are determined by swings in crowd psychology. People can and do change their minds, and so do markets. Major technical principle: never go for perfection, always shoot for consistency. In the quest of sophisticated mathematical techniques, some of the simplest and most basic techniques of technical analysis are often overlooked. Arguably, the simplest technique of all, and one that has been underused, is peak and trough progression. See Chart 1.1. Chart 1.1: Moody's AAA bond yields and peak and trough analysis. In Chart 1.1, the solid line of the yield corresponds to primary bull and bear markets. The series of rising peaks and troughs extended from the end of World War II until September 1981. This was a long period even by secular trends. Confirmation of the post-1981 downstream was given in 1985 as the series of rising peaks and troughs was reversed. The signal simply indicated a change in trend but gave no indication as to its magnitude. Moody's AAA yields, cyclical or primary trends, first breaking rising peaks and troughs in the post-war period. This principle reflects Charles Dawes' original observation that a rising market moves in a series of waves, with each rally and reaction being higher than its predecessor. When the series of rising peaks and troughs is interrupted, a trend reversal is signaled. When the series of rising peaks and troughs is interrupted, a trend reversal is signaled. To explain this approach, Dow used an analogy with the ripple effect of waves on a seashore. He pointed out that just as it was possible for someone on the beach to identify the turning of the tide by reversal of receding wave actions at low tide, so too could the same objective be achieved in the market by observing the price action. In figure 1.3, the price has been advancing in a series of waves, with each peak and trough reaching higher than its predecessor. Then, for the first time, a rally fails to move to a new high, and the subsequent reaction pushes it below the previous trough. This occurs at point X and gives a signal that the trend has reversed. Figure 1.3. reversal of rising peaks and troughs. Figure 1.5, 1.4, reversal of falling peaks and troughs. Figure 1.4 shows a similar situation, but this time the trend reversal is from a downward to an upward, from a downtrend to an uptrend. Figure 1.4 shows a similar situation, but this time the trend reversal is from a downtrend to an uptrend. The idea of the interruption of a series of peaks and troughs is a basic building block for both diagrams. Figure 1.4 shows a similar situation, but this time the trend reversal is from a downtrend to an uptrend. The idea of the interruption of a series of peaks and troughs is a basic building block for both Dow theory and price pattern analysis. Major technical principle. The significance of a peak and trough reversal is determined by the duration and magnitude of the rallies and reactions in question. For example, if it takes 2 to 3 weeks to complete each wave in a series of rallies and reactions, the trend reversal will be an intermediate one. Since intermediate price movements consist of a series of short-term 2 to 6 weeks fluctuation, similarly the interruption of a series of falling intermediate peaks and troughs by rising one signals a reversal from a primary bear to a primary bull market.